for tuning in. Let's talk. Welcome to the 8th episode. I'm your host, Elena Lau, CEO and real estate broker of Union Real Estate. On today's episode, I'm gonna give you an update of the greater housing market. And today I have Martin Yao again. Welcome back, Martin.
Thank you very much, Elena. Good morning. Good morning, our audience on Facebook. I'm happy to be here in your second month of Let's Talk. Congratulations.
Thank you, thank you. So today, Martin's gonna give an update of the state of real estate lending and more specifically to the non-QM mortgage programs. If you don't qualify for the conventional loans, probably this will be your answer for the non-QM. So stay in line. So Martin will be talking more about it. So let's dive into the real estate in numbers. For the month of June, in the single family market, there were 1,170 homes sold. Compared to last year, there is a change about 28% with a 12% month-to-month change. Average days on the market is about 42 days, which increased a little bit compared to last year, about 17%, but month-to-month it decreased about 7%, with an average sale price of $868,000, which we see an increase of about 7% from last year, and month-to-month about a 3% increase, which is good. So now we're gonna dive into more specifically week by week. So as you can see, the average day on the market has been taking much less day. We are going back to normal, as you can see. The property are moving faster since the reopening of the businesses. The number of sales pending, we have 440 numbers of homes that are under agreement. We're seeing an upward trend since all the reopening of Massachusetts. In terms of number of homes sold, there were 367 homes sold from last week. That is an increase of 85% from last year, which is tremendous. In terms of average list price compared to the sale price, we're seeing that are pretty much leveled. So we are seeing what I'm seeing in the market is competitive offers, sometimes with multiple offers, and some of them are waiving contingencies. Now diving into the condominium market, last month there were 769 condos sold, which is a 39% decrease from last year and about 35% decrease compared to last month. My speculation about this is probably people are trying to buy more larger homes, especially now that we have been living at home and utilizing the home as our home office, a place for our children to study as well. So I think people are moving towards bigger homes. In terms of average days on the market, is 40 days, which is an increase of about 8% from last year. And compared to last month, we're seeing a decrease of 11%. In terms of the average sale price is $190,000, which is a decrease of 19% from last year and 8% from last month. Like week by week, what we're seeing in terms of the average days on the market, this past week we're seeing a 40 days on the market, which is we're seeing a decline. You can see in the graph, which things are moving faster than before. In terms of the number of sale pending, we're seeing still an increase of sale pending. This last week, we had a sale pending of 312 houses. In terms of numbers sold listing, we had an increase of 236, which if you can see, we are pretty much getting back to the usual spring market. In terms of the average list price and the sale price, we're seeing that are pretty level. So those are great, great news for those people that are looking to buy or sell. I believe the interest rate are still low, which make it very attractive for the buyers to buy. And then for those who wants to sell, like I said before, there is still a shortage of inventory. So we are seeing multiple offer situations, so great time to sell as well. If you have any questions, just feel free to contact me. So right now, I want to jump into the conversation with Martin Yao. As I mentioned before, in the first premier program, he's the sales manager and senior loan officer at CrossCountry Mortgage, and he has more than 16 years in the residential real estate lending industry, and plus more than 2 decades in real estate investing in the US and Latin America. And he also has more than 15 years investing in renovating property in the New England area. So tons of experience, so I can't wait to dive into the conversation, Martin.
Thank you very much, Elena. And again, thank you very much for inviting me in your second month. It's an honor to be in your program, and congratulations for informing the Facebook audience of all this news that is going on in these unprecedented times. And I think that information is very important for everyone. But let's go into the topic of today, Elena. Before I start, I'm going to share my screen in a couple of seconds because we don't have minutes here. It's very fast, and we'll try to cover as much information as we can. But remember that at the beginning of COVID-19, which was at the middle of March, I was mentioning to you that there were some programs that were disappearing in the market, or they were, or lenders were putting them in standby because they didn't know what was going to happen during this pandemic. So these programs were alternatives to the conventional programs that I'm going to explain a little bit, well, in a few seconds. And they were very useful for those clients, those borrowers who thought that they couldn't qualify for a mortgage, or they went to a bank and they were denied. And through these kind of programs, we could help them out. That was the great news until, as I said, March 15th. The not so great news was that these programs were put in standby, and unfortunately they were not provided. But we have, current news that now they are back, and they are back and running and active, and we can help more people achieve their goal of acquiring property in the United States, or achieving their goal of buying their first property. So let's go to the details. Let me share my screen fastly.
That sounds great. So that basically opens up more opportunity for borrowers that couldn't purchase home with the traditional loans, right? Yes,
Elena. Yes, you said it right. And let's go and see it in details. No. So, well, as you mentioned, my bank is CrossCountry Mortgage. I am going to talk about the non-QM programs that I was mentioning. No, these is the alternative to the conventional loan programs that are offered by government in these government-sponsored enterprises, which are Fannie Mae and Freddie Mac. So, what are the new non-QM mortgage programs? The non-QM mortgage programs are non-qualified mortgage programs, which include a range of comprehensive loan products from borrowers that don't fit the conforming guidelines. Non-QM lenders will qualify borrowers based on alternative methods instead of the standard methods of conventional agency or government insured loans. Just to give you a very basic definition of what is a conventional or conforming conventional guideline, it's what I call the 222, basically the 222 policy. So you are not going to forget it, Elena, which means that on a conventional guideline, the borrower needs to comply with 2 years of credit experience, 2 years of working experience, and 2 years of legal residence in this country. When we talk about credit experience, and they need to have 2 years of experience usually for a lender, a conventional lender, to approve a loan. No, and this credit experience is validated by the credit bureaus, which is basically TransUnion, Equifax, and I always forget the last one. It's going to come back. And regarding working experience, no, the working experience has to be a working experience of 2 years in the same line of work. In other words, if a person is working in a medical field and within 2 years they change to a job in the restaurant industry, that is breaking the 2 years working experience. It has to be 2 years of working experience in the same line of work. No, and finally, the 2 years of residence or 2 years of legal status. Most of the lenders require 2 years of being a US citizen, permanent resident, or having a working permit in this country. No, but if you don't have it, the non-QM programs are very good for that. So which are the main non-QM programs? No, basically I call them the Fab Five or the Fabulous Five, which are the bank statement program, the Non-Warrantable Condo program, the ITIN program or ITIN number program or tax ID program, the debt service coverage ratio or this SCR program, and the foreign national program that I'm going to explain in details in a couple of seconds. Do you have any questions, Elena? That I see you there with your eyes wide open.
Well, you answered my question. I was gonna ask you about like to define in basic terms what is a QM, but you already answered that. And
don't forget about that 2-2-2 policy. 2 years of credit history, 2 years of working history, and 2 years of legal residence.
Those are like for the other type of program.
Exactly. That's a very basic general definition of what is a conventional guideline.
Correct.
Not necessarily a conventional guidelines for this government-sponsored enterprises as Fannie Mae and Freddie Mac, but most of the conventional lenders, which could be traditional banks, trade unions, etc., would follow this 2-2-2 rule. Obviously, there's other guidelines, but I don't want to get too much in detail because it gets a little bit more tricky and complicated.
Right.
Okay, so let's go to the first program, the bank statement program. What is the bank statement program? It is great for people who are self-employed or business owners, Elena. No, these business owners, borrowers that sometimes they don't show their income in their tax returns, but they do have a cash flow of money that can validate that they can basically afford buying a property. So this is a great program because if you cannot show formally by tax returns, pay stubs, 1099s, W-2s, your income, you can use 24-month bank statements to show the cash flow that you're receiving or the cash flow of the deposits that you're receiving in your bank. And it doesn't have to be a business account. We also can take personal accounts to do that. The caveat here is that you need to have a business. That business has to be shown somehow. And as you see in the bullet point 3, not necessarily you have to show a tax return. That's a great thing. Okay. You don't need a tax return or you don't need to show a profit and loss. You can only show the bank statements and then you can give us a certificate of incorporation of your company or your business or your LLC, and we just take that in substitution of a tax return. So that's big. That's big in this program. We go up to 80% loan to value. In other words, we only require 20% down payment, and we can finance up to $3 million in loan amounts. No, the borrower doesn't need to be 100% owner of their business. They can be a partner in the business, or they can partner up with 3 partners and own 33% of the company, and they still can qualify, and we can use his bank statements to show the stream of cash flow that he has. As I mentioned, we can take business and personal accounts, and also a big guideline that substitutes what you cannot do in the traditional conventional loan programs is that NSFs, which is non-sufficient funds or overdrafts that are showing in your account, are not a deal killer. Usually when you are in the conventional arena, if you have an NSF or an overdraft, they will question that, and most likely they will disapprove that loan because you are showing there that you are not paying on time your dues. But in this bank statement program, we know it makes sense underwriting. So the underwriters would understand that sometimes it happens.
All right. So question about this.
Yes.
So how about sourcing the funds? Like, will you do that? And if does it need to be seasoned? Is there a seasoning period? Great
question, Elena. Great question, because most likely many people will have that in mind. In case of the bank statements, well, what happens in a conventional loan? When you have a large deposit, and usually large deposits every deposit is over $1,000, you have to not only source the deposit but season it. By meaning sourcing the deposit, we need to prove where that money is coming from. And by seasoning, it means that that money should be at least 30 to 60 days in that bank account. In this program, which is a great program, as I said, you don't need to do that. As long as the underwriter can understand the kind of business that you're doing and they can see a consistent flow, let's say, let me give you an example. Let's say if we have a borrower who is a contractor, and he does construction work, and he receives money from his clients, and also it can be cash. But usually consistently every month he receives checks of $5,000 to $8,000. And it's always that his consistent flow. The underwriter is not going to ask any questions because they are going to understand, the lender is going to basically take those kind of deposits as if it was your normal cash flow of doing business. But let's say that you usually have a $6,000 deposit per week or every other day, and then in a sudden there's $100,000 in deposit going into your account, then they're going to question that. So it's a lot of mixed sense underwriting, because imagine from $6,000 you receive $100,000 in a deposit that usually you don't have within your 24-month history. That's something that they're going to question, and they're going to try to source and seize on that money. Just to prevent that, just to prevent the issue of money laundering, based on the Patriot Act.
Okay, all right.
Any questions? Any more questions? Okay, let's continue. Now let me explain you the Non-Warrantable Condo Program. This is a great program, especially for many of your clients, Elena. That we know that sometimes they try to buy a condo, especially it could be a luxury condo, and unfortunately, it doesn't fall into the conventional guidelines. Why? Because maybe most of the condos on the condo project is owned by investors, or people are renting them out, or half of that building is commercial building, or it's a new construction, and you know how much headaches we go through. How many headaches we go through when that happens. Well, with this kind of programs, I solve your problem, especially for you, Elena, because we accept mostly many kind of investment of condos, many types of condos, especially from primary resident condos all the way to second homes and also investment condos. We can go up to 75 loan to value. In other words, we only require 25% down payment. And we go up to $2 million in loan amount. We do accept that this new construction building, so we can finance through this program the first unit that's being sold in this new construction. And we do accept that the building is 50% commercial, which is okay. We do also accept asset depletion, which means that if, for example, one of your clients, those rich clients that you usually serve, is retired and they cannot show income, we can use their liquid assets obviously going through a formula to show that he has the means to pay for that mortgage. And what, just to give you a simple, a simple calculation, we take the liquid assets that could be cash, could be investments in his retirement funds, can be investment in stocks, bonds, etc. And we divided that into 120 months, basically assuming that he's going to pay that, that mortgage in 120 months, even though the mortgage, it has a 360-month term. No, and finally, we can finance purchases and also do rate and term and cash out refinance.
All right.
Any questions so far?
Yeah, can you elaborate more on the asset depletion?
Yes, and that is a very good question, because that works, very good for those clients who cannot show their income. No, because they can be, as we mentioned before, they can be business owners or even a retired person that he's not receiving income from a job, but now he's living from his savings. He can use those liquid assets as a calculation of not showing his income to be able to pay that mortgage. And as I mentioned, what we do is to take all the total net liquid asset amount that they have, and divide that into 120 month payments. And that result is what we use as income, not to qualify the client and to allow him to comply with the debt income ratio that we usually use to calculate mortgage programs.
Okay. Thank you, Martin. Let's
continue. How are we with the time? Okay, we still have eight more minutes. Okay, then we have this great program, which is the ITIN program, or the tax ID program. Many people know it as that tax ID. And the beauty of this program is that you don't need to have a social security number. That is very important. In other words, you don't need to have a social security number. You don't need to have a legal status in this country. That what this program requires is 2 years of declaring tax returns or 24-month bank statements, meaning that if you are paying your taxes, if for the last 2 years, you can be eligible with this program, only showing the ITIN number letter, the ITIN letter of the IRS. What is ITIN? It's the individual tax identification number that the IRS provides to every taxpayer in this country. That replaces the Social Security, and I want to stress that no Social Security number. We can go up to 74% loan to value, and we only finance in this program, specific program, primary residences, and for obvious reasons. So before COVID-19, in other words, at the end of April, the end of February, this program could allow people to finance also investment properties, but now that portion of the program disappeared for obvious reasons. We only require 600 credit score, which is very low, as you know. We do accept 100% gift funds from relatives, and we finance most residential property types as 1 to 4 unit or 1 to 4 family properties in condominiums, in condos. And the loan amount in this program is capped at $650,000, and we do accept purchases in refinances too. Any questions, Elena?
All right, so can you tell me, what kind of borrowers will benefit from this program? I know that you mentioned no Social Security, but can you elaborate more on that?
Yeah, no, great question. Great question, and it's good to clarify that. Those borrowers who have been in this country for a long time, but unfortunately they didn't get the legal status yet, or they're in process of getting their legal status. In other words, they are not a permanent resident, they are not citizens, and they don't have a working permit, but they have been paying their tax. They are working in this economy, paying their taxes, in complying with the IRS. Those are the kind of clients who could benefit for this kind of program. And the great thing is that as long as they pay, because what the lender is investing here is in the fact that they have been good paying their taxes, basically good non-legal residents in this country in complying with all the law. And that's the reward they are doing for it. And this, as I said, is a program that is available. It's available not at the extent that we had it in February, but it's still available, and that can satisfy many people who think that they cannot qualify because they don't have a social security number.
Okay, that sounds good. All right, we are very tight on time.
Okay, so let me go ahead and finish this, and then you can ask me at the end of the presentation any other questions that we have or any other questions that the audience have. Okay, so the 4 Fabulous 5 program is a debt service coverage ratio, DSCR program, which I call it the investor's delight. And why? Because this is great for people purchasing investment properties. Why? Because it doesn't require income, Ellen. Believe it or not, it doesn't require income. It's basically a non-income verification program where we only qualify the cash flow of the rent, the cash flow of the property, the cash flow of the rental income of the property. And what we do is to get the net monthly rental income and divide it by the TIA, which is the principal interest taxes insurance, and in A, if there is an association due. Maybe if someone wants to purchase a condo, there's condo fees because there's a homeowner association. That due is is basically factored into the equation, and that ratio has to give you a positive number. As long as it is positive and we're showing that there's positive cash flow in that investment, the person is approved. Obviously, they have to approve also with having good credit, and in this case, also we can accept up to 600 minimum credit score, which is also low. We can finance through this program 70%, a 70% loan to value, and up to a loan amount of 750,000. We can do purchases, rate and term refinances, and cash out refinances. We can finance up to 10 loans through this program. And let me clarify this. The investor can have 100 loans around the system, and we still can qualify him for 10 extra loans through this program, as long as he qualifies through the guidance of this program. And finally, we can do non-warrantable condos, which I already explained what they are. And we also can accept people who are foreign nationals, which I'm going to explain it in my next slide. So let's go to the foreign national program, which is the last Fab 5. This is for clients that are not residents, permanent residents, or US citizens of the United States, but they do have a visa. And we accept multiple visa status, even a tourist visa. That, the condition here is that he has to have an approved and valid visa at the time he applies for the mortgage. Okay, so that is important because the visa has to be acceptable and valid. So it cannot be expired. It needs to be valid. Okay, we don't require tax returns. A foreign credit report is allowed. In other words, if he doesn't have credit history in this country, but he has credit history in his country, or his country, that we can take that into account, and that definitely would help them in the rates. The loan to value, the max loan to value here is 65%, meaning that that person does have to put 45% down payment. We can do owner-occupied second homes and investment properties. We can take foreign funds that can be in a foreign bank account as long as it's in that account for 30 days. We do have to validate 30 days history. We, as I mentioned, take many kinds of visas, from F1s, they can be investment visas, all the way to B1s, which are tourist visas, but have to be current and active and in good standing. And we do apply the debt service coverage ratio program in this kind of or a program in this kind of program. Also, it's a merge of two programs, which is acceptable. And again, thank you very much for your invitation, Elena. I'm hoping to contribute to your program for many months to come. Don't take my word, please.
I'm gonna take it. So thank you so much, Martin. Lots of great information. I'm sure we'll have a lot more questions, but for now, I'm also interested on the 4th program that you mentioned, the debt service coverage ratio for the investors. My understanding is that for conventional lender, like an investor can get a loan up to 5 loans, correct?
That is correct. In reality, it was up to 4 loans.
4, okay.
But the guideline changed in 2009, 2010. So the conventional, because during that period of recession, a lot of people wanted to refinance several properties and things like that. They extended that number in the conventional arena from 8 to 10, but that's it. No, so once you already fulfill that quota, you cannot basically finance any other property through that kind of loan. So this would be a good alternative to supplement an investor who is not eligible for any conventional loan or a conventional loan anymore. And we can give them 10 more. It's not up to 10. We can give them 10 more. So let's say he already fulfilled his quota of 10 with through conventional loans. We can supplement 10 more loans through this program.
That's great. So this program, I would think is much cheaper than going through a hard money lender.
It's much cheaper. The difference in rate from this program in a conventional loan is maybe 1.5% to 2%. Okay. You know that now, if you want to get hard money, before until March of this year, the hard money market was around 9%. Now it's between 10 to 12%. This is something much cheaper because we are talking about maybe the low to mid 6%, which is not so bad.
All right. So one more question for the foreign national from me is how are you sourcing the funds? Are you sourcing the cash, like check deposits?
A very good question, because as I mentioned it when I was explaining that slide, the funds have to be 30 days in a bank account. Could be a bank account in the United States, or could be a bank account in their home country.
Okay. All right. So let's go to the audience. I'm seeing that Bonnie Lai has a question. I believe that was when you were talking about the 222 rule. She's asking, does it matter if the jobs were part-time and not from the same industry?
That's on the convention. I suppose that she's asking that question on the conventional arena.
I believe so. It was early in the show, so I sent her a message to clarify, but maybe you can talk about on both scenarios.
And first of all, good morning, Bonnie. Thank you for tuning. If your question is related to the conventional arena, yes, as long as a person can validate that they have 2 consecutive years in the same line of work, we can take full-time jobs or part-time jobs. In the non-QM, everything is possible. It makes sense on the writing. As long as a person can show that they have the income, and if they cannot show it formally, they can show it through bank statements, or they are receiving the cash flow, we can make it happen.
Okay, that sounds good. So we also had Jacqueline Goose saying that she always loves your information. So you are doing a great job.
Thank you very much, Jacqueline. Thank you for tuning. Always a great fan, and we also a great fan of you.
So I have one more question regarding the foreign national. In the recent news, there has been talking about like a student visa being revoked. Can student visa holders go through the foreign national program?
That's a very good question, Elena, because it's something that was announced 2 days ago. In reality, that's a very tricky question. My initial response to you is yes, because remember, the condition is that they have a current visa that is not expired and in good standing. But if by chance the government decides to invite these people out of the country and then they revoke their visas, unfortunately, they are not going to be able to qualify.
I see. Okay.
So it's a tricky question because it's unknown right now. We don't know what the government is going to do. Hopefully, it's not going to happen. And as long as they have their updated visa and it's valid, we can obviously help them finance that property.
All
but
right.
if the government changes its mind, it will be different.
Okay. Well, thank you so much, Martin, and all the audience.
You're very welcome.
Bonnie, Jacqueline for tuning. I saw Scott as well. So thank you so much. So that's what we have for now. We are up in time. So if you have any further questions, feel free to contact me. My contact information is right here. For next episode, we're gonna have Abby Nguyen-Burke. She is the business banking relationship manager at Eastern Bank, and then she will be talking about further about the PPP program and about the loan forgiveness process. So if you have applied for that program, tune in next week on Wednesday, same time, same channel. All right, that's what we have for today. Thank you so much.